There's a lot of distress there. There's some distress in new construction, depending on how they were levered. Clearly, if you were using bank money at 65%, you're probably fine, except that you're not going to make money is the problem. This is this is human survival too. They'll figure out whatever way they can to continue to play. And so that's what we're seeing right now. Yeah, I have a friend who's in the investment business who calls this a hope certificate to death, which is one of my favorite quotes.
Hi, Adam Gower here, founder of gowercrowd.com and host of this YouTube and podcast series, Real Estate Market Watch, current events through a real estate lens. My guest today is Joe Blackbourn, who is president and founder of Everest Holdings out of Phoenix. Everest has completed 69 investments for a total capitalization of $743 million since inception. And Joe was recently invited to the Urban Land Institute to give a presentation on the market for multifamily real estate asset class. And it is in regard to that presentation that Joe and I are talking today. He will go through some of his insights based on the research that he did. And we do actually share a couple of slides during today's podcast. So if you are listening, I do try to describe what we're looking at, but if you get a chance, just go to youtube.com and look up Gower Crowd, and you will be able to find the podcast there. You'll be able to watch along. You can also find a link to the podcast at gowercrowd.com. Click the podcast link, and while you're there on the website, go ahead and subscribe to my newsletter if you've not already done so. I include detailed summaries of these conversations, a conversation with Joe and others in this series. So you can read the highlights of my discussions as well as listening to them if you so wish. Okay, all there at gowercrowd.com. All right, let's move on. Joe Blackbourn of Everest Holdings here. Fascinating discussion on the state of the multi-family real estate market. And we do touch on some other topics as well, coming right up. Joe, always a pleasure to see you. Thanks so much for joining me. Really is good to see you, actually.
My pleasure to see you, Adam.
All right, so you sent me over a few decks here. Why don't you tell me basically the story of how you came to an underdressed weatherman? It's quite impressive where you were presenting this, and then we'll go ahead and we'll have a look at it. It's a little bit out of date, but we'll bring everybody up to date on these numbers. So, what's the background to this thing?
Yeah, so I was fortunate enough to be asked to speak to my National Product Council at ULI in New York in the spring of 24. And they wanted to hear about what was going on in the multifamily marketplace across the Sunbelt, including capital markets, supply and demand trends, perhaps some forward-looking discussion, and really also some boots on the ground case studies in terms of how those trends were being expressed on the street. And so by the time we got done with my team got done with the presentation, and they do a really good job with these from a data perspective, they asked me what I wanted to call it. And so I defaulted to how I was feeling, which was I said, let's call it an underdressed weatherman gets sent to the hurricane in essence. And so that became a motif for the presentation. We have these graphics of this swirling mass of raging weather off the coast, like we often see on the news. And then the question is, where's it going to land? How bad's it going to be? And all of those arrows and all of those graphics. And so we threaded that through the presentation because we were feeling like there was a lot of stormy weather on the horizon, but we don't know quite where it's going to land and how bad it's going to be.
Okay, I love it. So why don't we share some of these slides? The irony, actually, of this storm that you are reporting on is that it was I know you've updated it. So you updated
Yep.
it November 24. Looking forward to it being updated again. But we're going to do that verbally today. We're going to update some of these
Okay.
data to talk about the topics. But of course, since November 24, everything has calmed down and there's no so yeah, the weather's changed. So anyway, I'm going to go ahead and share my screen. Let's just hope I share the right one. Here we go. So here's our weatherman,
Yep.
Joe. He's in a gale force wind here, and I've managed to do full screen. So let's see if I can actually.
Don't you think it's funny that they always have to send somebody to stand there and get blown around in the wind?
They don't have someone there. They don't have one of the. They don't have like weather machines or something.
It's like
They've got
you
to.
don't actually need to put somebody at risk in order to report this weather, right?
Oh my goodness, he gets paid overtime or something. All right. So somewhere over the ocean, we've got a big hurricane here. I like the analogy, but something's headed towards us, and we're not sure how it's going to hit. All right, so why don't we go through this? I mean, you said that I should pick out some of these charts,
Yeah.
but you know them obviously better than I do, so we can kind of jump through. There's quite a few in here. Uh,
So the point here, and I'll jump in as you put slides up because I'm prone to do that, and I'm also prone to interrupt in an irritating fashion, is that we're all talking about this inflation rate now being under control, and it is. It's in the twos, and obviously there's a lot of pressure for the Fed to lower rates. But what happened after COVID was pretty much a shock to the system. And you think about the whole bit with eggs and now beef and all of that. And the food prices, and this graph obviously is self-explanatory, but even if we're at 2% now, we're up 30% in
right.
a very short period of time. And it's not just food, by the way, it's rents. But to think about the home price appreciation in any respective market across the United States where you live, then except for perhaps where I grew up in a rural town in Wisconsin, right? It's in a lot of neighborhoods, and where I'm sitting right now in Southern California, in this particular area, I think home price appreciation has been 50% since
It's extraordinary.
2020.
Well, so just so for those folk that aren't watching this on YouTube or otherwise by video, we're looking at a chart here of food prices, a graph of food prices showing kind of base level of just a tad over 100. It looks like in late 21, that is now exactly as you describe, 130. It's gone up 30%. And the bit the economists what's this? Oh, the bit that normal people care about is the rise. The
Yep.
bit that economists care about is the tail end of that. What does that mean? What do the economists care about? What are they looking at here?
Well, they're looking at current CPI. They're looking at whether it's under control or not. And in order to manage policies or recommend, strategies moving forward. And obviously, we've been through inflation shocks before, notably the 70s and 80s, where, the point I think also is it's really difficult to give that pricing back. Once that new baseline is established, it appears the best we can manage, short of some real economic calamity in a particular economic sector, is slower growth as opposed to a decline in consumer pricing.
Yeah, it's really interesting you say that actually. So we were just chatting about build to rent and single family, and now
Mhm.
you're talking about baselines being set, right?
Mhm.
Once prices go up, it's really difficult to back off from them. Joe, we've seen them in our careers, home prices fall substantially. And yet people don't think that that's likely or actually, although people don't think it's even remotely a
Mhm.
possibility. Do you think that is a possibility in the future, or did we really reset home prices at 30 to 50% above what they were, in 21, 22 in the last few years, do you think? Like
Well,
literally,
I've been in the business for a long time, and I've been a student of the housing market for a long time, and there really has only been one fairly short but very painful period of time when U.S. housing stock value dropped, and that was following the GFC or in the GFC period, because we had experienced not just quite an acute oversupply in the housing market, but a financial markets um, um, the serious financial markets problem created by the U.S. housing market. And so um, going into this particular situation or pickle that we find ourselves in now, I find it much less likely that one could project that any kind of a significant drop in the value of the U.S. housing stock just because we went into it with an undersupply. We have really robust demand for housing. Costs for materials and labor are really under pressure. And so and we have a locked up market, as I know you and I have discussed before. So one would have to, I think, anticipate a calamity in the US economy in order to anticipate much downward pressure on pricing. That's just my humble opinion.
Again, I was going to joke. I shouldn't be too flippant. I was going to say, yeah, but you were there, weren't you? And you must remember what it was like after the Great Depression. Surely house prices. But
Like I said, I've been in business a long time.
but what about the savings and loan crisis, right? That
You know what? Housing values didn't drop that
ended
much.
up in Japan, so I didn't see what happened here. It didn't impact home prices, no.
It did. But what happened really was, and you and I actually touched on this
Mm,
previously too. It was land development that was significantly overbought and overleveraged
mm.
across the Sunbelt of the United States, once again, driven by savings and loans. And so that did create a period of time when infrastructure was able to be purchased at a discount and some housing stock, but a lot of that was picking up the pieces and starting over. But if you look at the resale value across those impacted markets, they went to flat by and large. And we've looked at that data in the past, maybe a little down, nothing like the GFC. When you looked at, for example, my home market, the Phoenix area, one of the poster child growth markets in the country, the 2006 to call it 2009 decline in the median um, resale value was negative 50%.
It went down 50%. That was global financial crisis, right, in Phoenix.
Mm-hmm.
Yeah, Phoenix imploded, and so did like San Bernardino, and there were other markets that just collapsed completely. You don't see. I mean, it would have been possible to predict that, obviously. So it's unfair to even ask it. But is there no circumstance you think with everything going on at the moment that we could see a reversal, similar reversal with housing prices there, especially this gap between affordability and income and cost and etc. And it just seems untenable.
Well, it's less tenable if you want to own a home. I don't see it. I really don't. What I see is declining home ownership rate slowly over time, higher rentership rate slowly over time, more renters by choice perhaps than we've seen. And by the way, on the renter side, what we're seeing in new projects is a higher income demographic really than we've ever seen. Really high credit quality, which I think is reflective of that.
Isn't that interesting?
Mhm.
It is, isn't it? So you're just seeing higher credit, higher income people renting than you've been used to.
And at the same time, in the vintage, call it BC area, we have renters under pressure. Yeah,
Really?
they're making a little bit more than they used to make, but rents going back to that inflation chart,
Mm.
rents are up that much and over a fairly short period of time, and they're not making that much more. And
Mm.
those are not the $120,000 a year people that we're seeing in a new Class A deal in suburban Dallas or suburban Scottsdale, right? Those are folks that are, you know, in a lot of cases, paycheck to paycheck, and they've gotten, perhaps 7, 8% annualized wage growth, which is really strong during this inflationary period, but it's not enough to keep up with a, 30 or 35%, delta in their base rent check.
Incredible, isn't it? How expensive it is. Okay, so let's take a look at this one. I'm going to jump now to treasuries. Okay, so this one's an interesting one. This chart shows it's a graph or a chart, and it's a graph, isn't it? I always forget
Hmm.
whether it's a graph or a chart. Anyway, graph. But it's showing Fed funds versus the 10-year Treasury, which is interesting. It does end 11/3/24. So what we're looking at is Fed funds rate kind of gradually going up from 22, stepping up to 5.5%, and then ticking down towards the end of last year. And then the 10-year Treasuries, well, the interesting story here is Treasuries are not playing ball. So up until then, what was going on with Treasuries? And what is the relationship between Fed funds and the 10-year Treasury? And then let's talk about what's been going on over the last 6 months. Actually, more than that, 8 now, almost.
Well, honestly, I think that this is pretty much more of the same. I mean, if you look at the 10-year here, we're right about there now, 440-ish.
Yeah.
And so I think that going into what we saw as a cutting cycle and was widely reported as a fresh cutting cycle, even by the Fed, we expected treasuries to follow suit. Most people expected treasuries to follow suit, just based upon, and by the way, obviously poor rationale, because I think the treasuries market is an independent marketplace where people are betting on the credit worthiness and strength of the United States in relative terms. And obviously it's a safe haven and the need for a safe haven is driven by, how people feel about the world. And these treasury auctions haven't been that robust. And, there hasn't been good support from the Fed like we had seen previously in a QE kind of environment. And so I just think there's a lot of wishful thinking surrounding what people think the treasury market is going to do because all of our valuations wheel off the 10-year by and large. Right. And so people want that pushed down to the long-term average, if at all possible. When the long-term average, and by that, I think that is something over the last 20 years is call it closer to 3%.
Scott, that's been a profound topic of conversation since your chart ended here, which was November last year,
Mhm.
just a couple of months before the new administration was sworn in, or before President Trump was sworn in January. And a lot's happened since then. It's been a lot of external pressure by POTUS on the Fed to
Mhm.
reduce interest rates. And then the pushback immediately after the tariff Liberation Day was from what has become known as the bond vigilantes, which I've learned just means the bond market. It's not like guys
Mhm.
in masks
Mhm.
galloping around somewhere, which is what I originally thought it probably was. But just the natural forces of the bond market pushing rates back up because of this kind of lack of confidence in the independence of the Fed. So, what have you seen? Like, what's your view on all of that over the last 6 months? This is a big filler since you filled this, you completed this chart. Yeah.
This is an area I'm not smart enough to comment on with any reliability. I'll throw out that disclaimer.
Okay.
I just think that the United States is not currently creating sort of reputational calm. And I do think that the bond market wants calm. And historically, honestly, I think you could still bet that in 3 or 4 years from now, the Treasury might be lower than it is today. I just think that today nobody's feeling very calm, and it's being reflected not just in the bond market, but in consumer sales, consumer sentiment, I just think there's some stuff rippling through how people are behaving today that aren't being seen in the economic numbers yet that relate to how they're not calm currently. They're feeling uh, there's some fight or flight out there that's being expressed in these numbers.
Well, Joe, what's going on in multifamily? I know this is clearly you've got, I don't know, 20, 30 pages here. It's an awesome presentation. We're not going to be able to get through all of it today, unfortunately. But what are you seeing in terms of multifamily? What I'm going to kind of suggest what I think is going on by asking you, what is hidden under the surface? You and I have had a run at a few things over the last few months.
Yeah.
We've looked at some deals actually a long time ago. That Georgia deal, that was ages ago. It's like it almost seems years ago that we looked at that. But um, what's going on? How much distress is there, do you think, in multifamily across the country, hidden
Uh,
away from plain sight?
Oh, a fair amount.
Mm,
I do think, by the way, I really enjoyed your last podcast with the gentleman that was on from CBRE, where
yeah.
he really, and you and I exchanged a note after that, where, he described this from the top down really as being pretty calm adjustment.
Mm,
I'm overusing that term, but from the bottom up, from the street level, there's a lot of stress, and it's balance sheet stress. And by the way, it's not being helped very much by property level performance. So a lot of problems get solved if you have NOI growth. And there isn't NOI growth organically in most of the Sunbelt markets, the high growth markets that are having a lot of supply additions. And there won't be for a bit. In the meantime, all of this balance sheet maintenance has been going on, playing for a lower rate environment and potentially a different execution that might be available either for sale or refinance or whatever in a lower rate environment. It hasn't happened.
mhm,
So that stress, as we all know, there's a certain life to it, and then people are like, "We're done. We can't. We are out of life. We will throw in the towel." And so that capitulation phase, and I'm not sure what it's going to look like, or whether it will even arrive in a large way, but it's been prolonged. And and by the way, it's not just apartments. I know it's office and banks, that are more exposed to office, but in apartments where you really have the component of the market that's been overbought, it's the pandemic driven debt fund financed syndicated um, value add vintage apartments in much of the Sun Belt. And there was a lot of that done, many,
mhm,
many billions of dollars. And a lot of that paper sits in CLOs, and a lot of that is functionally underwater. In other
mhm,
words, it might be covering plus or minus 1.0, in some cases not. And yet, there's a lot of, I think, and by the way, good reason for it. There's a lot of work in these situations to try to put bandages on and play for another day. There's a lot of distress there. There's some distress in new construction, where, and depending on how they were levered. Clearly, if you were using bank money at 65%, you're probably fine, except that you're not going to make money is the problem. And I'm overgeneralizing terribly, but we came out of a period of time here where people were making stupid money on the merchant built exits, where they're selling it in the fours, and they're in those valuations for a new product by and large are down by, call it 30%, 25, 30%. So a lot of this stuff is going to clear
mhm,
maybe at about the loan balance or a little bit more. And so we're seeing that happen. But
mhm,
operators are trying not to do that, if at all possible. They're trying to extend, they're trying to recapitalize. Those recapitalizations, I think, are painful and costly. So that's distress also. And then you have, of course, as I mentioned, if there's no NOI growth, That's hard. I mean, if you're managing your balance sheet and you're stressed about that, and you have to couple that with the incredibly intense blocking and tackling required at the property level, one, to keep good staff, two, to meet the market, three, to collect rents, because delinquencies and collections loss are double what they used to be.
Hmm.
And I'm overgeneralizing again, but that's what we're seeing, right? We're seeing lots of situations, and we see them because they're in the market and we're underwriting them, or in some cases we've financed them and we're looking at it. Where it's really taking all month to get the rents collected. You'd be the 15th of the month, and you have you know less than 50% of the rents in the door. Stuff like that, depending upon what market you're in. That's a lot of stress.
So why is just to anecdotally share with you, I was talking to the IR investor relations guy at about a $2 billion AUM multifamily shop that told me they had confidentially, so obviously I won't mention names, but they had 40 assets in their fund, of which he thought five were probably cash positive. Like total destruction, total implosion.
Cash positive after debt service.
No, yeah, below, but only five above debt service. The rest
Yep.
all negative, like bleeding money. And I said to him, so is that just you? I mean, this, by the way, is a super professional shop as well,
Mhm.
that have just really struggling. I asked him, are you seeing that elsewhere? He said everywhere. So why is this not more of what's going on in this market? Joe, I mean, again, you and I have talked about this for at least a couple of years. There's got to be something out there we can buy that's distressed, and yet, it, knowing as it's as bad as it is as we do, why are we not seeing more opportunistic buys, you think?
Well, because I think the debt fund operators are very smart people, and they're doing what we would do. And they're trying to play for another day also, right? And let's just say they are, in any given situation, their loan is plus or minus spot value for the property, right? And and if they can manage to leave an operator in place, and the operator is willing to inject a little bit of money and buy a hedge or whatever it is and get an extension for some period of time, why wouldn't you do that? It falls into that category, where they have decided, many of them, that that's the way to get through this. And even if it isn't, if it's a year or two or whatever it is, or three, and ultimately somebody has to pay the piper, or they have to own the property, or whatever it is, what have they lost? As long as they're getting paid along the way. And so I give them credit, for having figured that out. And we've seen, I mean, and obviously they figured it out pretty quickly. And so that's why we're not seeing much in that category. And then I do think there's a lot of, as Mike in my office, who's way smarter than I am, likes to say, this is this is human survival too. I mean, these are people, they want to survive, and when they get painted into a corner, and they'll figure out whatever way they can to continue to play. And so that's what we're seeing right now. And I have a friend who's in the investment business, who calls this a hope certificate to death, which is one of my favorite quotes. Because some people do feel like the writing is on the wall in a lot of these cases, and so it's just a question of time. So people can differ about that. Let's just say that Treasury did come in, to, something in the threes or something over a period of time. It certainly would change the investment, the dynamic and people's confidence in terms of putting stuff into the market to trade it. But I think that's been the issue, as we discussed. It's been stable. It's been higher than we expected, and so it feels like this really, really taut balloon, and the and fragile.
Are people waiting for interest rates to come down, do you think? I mean, people in
Oh,
general,
sure.
lenders, borrowers, is everyone just kind of hanging on, waiting for that? Is it a false hope, or do you think it's inevitable?
Did interest rates come down? I don't think it's
Yes.
inevitable. Let's start with that. I won't say it's a false hope. I don't know the answer to that, but I don't think it's inevitable. Yes, the answer is, by the way, I think it's within the debt fund's interests to persuade a borrower that rates are going to come down because borrowers are having to continue to put money into properties they're having to operate properties that are under stress. They're having to buy hedges, and it certainly looks more attractive to make that investment if rates are going to come down. And so I think that's there's some sort of um, let's put it this way. Back to this idea of surviving. There's some sort of a twisted rationale that people get to around the idea that rates will come down in order to support, injecting additional capital into a situation.
That's right. Yes, interesting psychology in the market, isn't there? It does
Mhm.
get back to this whole idea of the bomb vigilantes, which I know you don't want to talk about, but I do think that even if Trump does force somehow strong arm the Fed to reduce rates, that there's going to be pressure in the opposite direction that will
Do you
keep.
think he can do that?
Can he do that? Yeah, I do. I think he could put a shadow chairman in now that who would basically undermine everything. Everyone would start pricing in 2%, 200 basis points on, May 1st or whenever he takes over next year. And
Mhm.
Powell would essentially be a lame duck. No one, yeah, he's doing it, but we know it's all going to change in May. And we know
Mhm.
who, and the guy's already said what he's going to do. If, of course, you can get the other governors on board with him. So I do think that that is a possibility. I also think that this whole idea of the building, if you're following this 3 point something billion-dollar renovation of the Fed building in Washington or something, everyone was blaming Powell for overruns on this marble everywhere. It's like a palace. It's like this, he's going to fire him for incompetence on something completely unrelated. Anyway, that's a whole different story. But yeah,
Did you see the press conference where they disagreed in front of the press?
yes, I didn't watch. I didn't watch. I'm not that much of a glutton for punishment to actually. I read it.
Mm.
What he said. Yeah, I did.
Pretty uncomfortable moment as moments go.
Yeah, it didn't. Powell looked at this thing and said, "No, no, that was for the other building." Well, what are you doing? When's that going to be? It was finished 5 years ago. What can I tell you? Somehow you've got it in the budget. But no, I mean, there's nothing. If we want for nothing on the entertainment front these days, at least when it comes to Washington. So anyway, looking, it's already, gosh, look, we're both at 4 o'clock. I'm gonna have to stop in 10 minutes, but because I got a 4:15, I know you've got a bit more time. But I'm just kind of scanning through this thing. Why don't you just tell me something about supply? Because one of the big issues with pricing in multifamily, single family, built to rent, whatever it is, lack of supply is what helps shore up prices. What's going on with supply, Joe, across the country in terms of multifamily?
Well, it's hard to talk about supply without also talking about demand, right? And I just think that don't forget we have a shortage of housing in this country in places people want to live. Start with that. And then in looking at supply, let's talk about what's happening right now. And that is nearly nothing works right now because of the rate environment combined with costs and very low to negative rent growth in lease up situations, new buildings. And you have to get to, let's just say, in some markets, a 6, and in other markets, a 7. And you could argue that if you were in a gateway city on the coast, you could get capital below that. But if you can't get into that range, forget about getting equity.
Mm,
And so it's one in what used to be viable projects. It's one in 50, maybe something like that, that actually can get penciled and capitalized. So it's the creme de la creme of sites. And
mm,
so we're seeing a precipitous decline in permitting. And at the same time that we've passed peak in terms of deliveries also. So, but prior to that, in 23 and 24 and going into this year, we've seen really high supply additions in all of the usual suspects, you know, Dallas, Fort Worth, Austin, Phoenix, Atlanta, you name it, lot of new supply.
mhm,
What's really interesting, and the real story here is, and by the way, these are supply numbers we haven't seen since the 80s. I mean, the 80s when it was tax driven and
mm,
just a whole different, can of worms. I mean, this was driven, this was very much a boom in the development business.
mm,
And stuff costs a lot more, and they're still little delivering it. But the real surprise, in my opinion, is we're seeing absorption, which is about keeping up with supply.
mm.
And we're going to start passing that point here if we continue absorption at the pace we're on, where we're going to have to hit that inflection point where we're absorbing more units than we're adding.
Isn't that fascinating? Where's everyone coming from? Like, where are all these people that are suddenly are these new households forming? It's not people, we've got a homeless problem as well, all over the place, but it's obviously, I mean, that's just a symptom of the housing crisis. But where is everyone coming from? Are they sharing and then splitting up to take their own places? Like, where's it all coming from?
Well, it's complicated to answer that question, and we've tried to answer it a lot of different ways. But one of the ways that you get to it is start looking at the average age and income level that is the first time home buyer today, and then compare it to what it was 10 years ago or even 5 years ago, and you'll get part of your answer. There are a lot of people that are either prolonging by choice or cannot make the choice to buy a home, or and by choice, I mean they just don't have great options, right? And because we have a housing market that's very difficult to crack. In most, even markets that used to be really easy to get into are locked up. And so I just think that that's contributing to a real strong tailwind for rental housing, especially high-end rental housing.
Mm. Yeah, that's right. I mean, we get off topic in the last like 4 minutes, but this build to rent asset class that you like. Okay, so I'll tell you what, in the last few minutes, where do you think we're headed? We're here talking end of July 2025. Half the year is gone, more than
Mhm.
half. What's going to happen in Q3, Q4, second half of this year? What do you see on the horizon? What's the weather forecast to your weatherman?
Well, it's mixed. Um,
Lovely.
but I would say um, if you start with the macro, okay, I think there's going to be more transaction volume in the second half of the year, and that's based upon conversations with broker teams that are getting more BOV action. Part of that is capitulation, part of that is we've set the pricing. Pricing for what's interesting is, pricing for high quality assets, cap rates have not jumped much. It's a 5 to 5.25 kind of range, and that's pretty. That's actually you can sell into that if you have the right basis, right? And on the vintage stuff, it'll be more capitulation that we'll see. It'll be more situations where people are like, where the lender's like, listen, there's no way to solve this. Take it to market, right? So that's going to create some deal flow. On the supply and demand side, first of all, one of the things that we're tracking right now, which we really didn't expect to happen, is there's really, and we're right now, and so we're looking really carefully at Phoenix, but I suspect this is similar in other markets. We're seeing a lot less inventory being delivered, at least reported by CoStar and Ron Witten and some others, than had initially been projected for the year because things are taking longer to finish.
Hmm.
At the same time, if you look at the first half of the year, we've had really robust absorption on a net basis. And so what we expected to happen in terms of an inflection point where rents could start to rebound may happen sooner than we had projected. And what we try to do is we try to model these things out. We try to model supply adds, net absorption, because there's a point, and by the way, it's not 95%. There's a point prior to that where when you get there, rents start to go up. If you look at history over many cycles, that's what happens. And we're going to get there, I believe, this year. And when we get there, and as permits continue to decline, I just think that we're going to see potentially surprising outperformance in the asset class. Sooner than perhaps one might have expected. Once again, mixed. I just think that there's a vacation in as it relates to vintage and quality, and it will relate in part to where is the tenant tapped out and where is the tenant not tapped out. And if you're in an asset type where you have all kinds of room, in other words, from a rent to income perspective, you have room to grow rents because, you have income profiles in the building where, you might be at today's rent at plus or minus 20%. When you're in California, it can be 50% in some places over there, right?
Sure can.
It's a little different than if you're in a vintage asset and you've had this quite robust inflation in rents over a fairly short period of time, and you might be at 25 to 30% already.
Joe, I hate to do this. I mean, I'm scanning. First of all, I really enjoy talking to you. Secondly, this presentation deck you've got here is about 300 pages long. And I'd love to go through every single page with you because it looks absolutely fascinating. So next time you give this presentation, let me know. We'll arrange for a wedding photographer to come along and video it, even if the ULI doesn't do that for you. I'd love to see the whole thing. But for now, I'm just going to have to, I'm so sorry. I'm going to have to cut it short because I do have a call in a couple of minutes I got to get on.
It was great to talk to you, Adam.
Joe, it's always a pleasure to know. Joe Blackbourn, president and founder, while guessing, Everest Holdings. Am I right?
You all right.
All right. Well, thanks for joining me again, Joe. It's good to see you.
Thanks, Adam.
All right, that was Joe Blackbourn, Everest Holdings. Joe, what an enormous pleasure seeing you. I kind of think of you as a good friend, even though we've never actually met in person. I don't know, maybe you don't exist. As we were talking, maybe you're an avatar somebody created out of AI. Who the heck? Maybe I am. You never know. Anyway, thanks for joining me today. Really enjoyed it. And I would like to see that entire presentation sometimes. Next time you do it, would love to see that. And thank you to dear viewers, dear listeners. Appreciate your spending time with us today. It is a fascinating world that we're in. And the next few months, as we get towards the end of the year, should prove no less interesting than the last few months. Let's put it that way. Anyway, thanks for joining me. If you're not subscribed, go ahead, sign up for my newsletter, gale-crowd.com. Subscribe, I should say. It's there, a big subscribe button on the website. And I summarize these conversations in some detail in that newsletter. It's totally free. You can always unsubscribe, all there at gale-crowd.com. But for this week's episode, that's all I've got. Thank you so much, and I will see you until next time. This is Adam Gower signing off.